Hey there, I'm glad you're joining me for another video. Whether you're a subscriber, regular viewer, or first-time looker on and you find this video helpful, please consider supporting my work by subscribing and spreading the word. You might find my content different from your average financial YouTuber, and I would like to keep it that way. So let's tune out the noise of short-term price prediction and the hot stocks of the week and actually learn about investing. One of, if not the easiest and most popular way of investing in stocks is through ETFs. Amongst these funds, the most popular are the ones tracking the S&P 500, an index consisting of the 500 largest publicly traded companies on the US stock market. It is hailed as the index to beat, and investors worldwide view it as their go-to fund. An exchange traded fund, or ETF, is essentially an openly traded fund, meaning any investor can buy and sell shares on the open exchanges. They usually carry a lower management fee than traditional index funds due to their passive nature. You can also expect a decent dividend on top if you go with a broader one, such as the S&P 500 ones. ETFs are simple, safe, and efficient. The S&P 500 index has earned its #1 spot with solid growth through ups and downs, beating out other major indexes such as MSCI Emerging Markets, Europe, Dow Jones, Hang Seng, or the FTSE 100. It's up almost 180% in the last decade and over 2,200% since 1980. Since its inception in 1926 and through 2018, the S&P 500 actually appreciated at an average rate of between 10 and 11% annually. If you invested $1,000 in 1926, it would have turned into $9,757,402 by 2018. That's excluded inflation and dividend. More realistically speaking though, after 10 years, $1,000 would become $2,714, 20 years, $7,366, and after 30 years, $19,993. These numbers, again, are not adjusted for dividend nor inflation, which almost balances each other out, so your actual result wouldn't be that far off these numbers. Needless to say, contributing what you can to an S&P 500 index fund, say on a monthly basis, can turn out huge gains in the long run. If you contribute only $200 every month to, say, Vanguard's VOO ETF, it will most likely grow to well above $450,000 in 30 years, meaning that even if you start out as late as 30, you can save enough to live off by the time you hit 60. The go-to S&P 500 ETFs are Vanguard's VOO, iShares, IVV, and SPDR's SPY. And these ETFs make up 3 of the 4 largest ETFs in the world. You pay less than 0.10% of your holding each year, so about 1% of your expected return only. They're all brilliant ETFs for broad exposure to the markets, and there is no easier way to get going. A great tool to get an overview of all available ETFs is ETF Database's ETF Screener. So head over to etfdb.com where you can search by category. There you can also sort ETFs and check out their expense ratio, dividend performance, ESG score, inflows and outflows, and much, much more. ETFs offer a sure way of getting the average return of the stock market, which will put you ahead of most individual stock pickers and even professional fund managers, who sometimes struggle keeping up with the S&P 500. Retail investors achieve an average of about 2.1% annually, while some studies suggest more than 70% of large-cap fund managers on Wall Street trail their benchmarks like the S&P 500. But why the S&P 500 and why the United States? Without getting involved in a philosophical or political debate, the US has simply beaten the rest of the world at economics and capitalism for a long, long time. Almost all the world's major companies, banks, and stock exchanges resides in the US, and more than 70% of all trading of shares occurs in the US. The US dollar is also the world's most stable currency and is also a global reserve currency. Investors therefore view the US as a safe haven for their money, and it's also a heavily regulated and scrutinized market in which all information is public. The most compelling argument besides its sheer outperformance are its components. I mean, who doesn't want to invest in iconic companies such as Apple, Microsoft, Tesla, Amazon, Visa, JP Morgan, Coca-Cola, Google, Intel, Nike, Disney, or PayPal? They are all pioneers of their industries and keeps innovating while maintaining their leading positions. They post bigger numbers and draws in more investors than international competitors, something I personally value highly. The index changes constantly, and you can rest assured as an investor that only the 500 leading companies gets to be a part of it at any given time. They all have to post stable profitability, have a market cap of more than $8.2 billion, and be highly liquid. This, of course, comes on top of the already tough requirements and regulatory oversight that comes with being a public company in the first place. So is the S&P 500 ETF the holy grail of passive investing, as some say? Well, if it isn't, it's at least the easiest and most efficient way to gain broad exposure to the overall stock market. And you can get a piece of the world's leading companies and beat 90% of investors without breaking a sweat. I would, however, also like to add a couple of tips at the end. Make sure you stay more or less 100% invested and don't sell unless you absolutely have to. Don't trade ETFs or try timing the market. Just buy whenever you have available cash and hold tight for the long run. And if possible, set up a dividend reinvestment plan or DRIP with your broker to avoid paying fees when reinvesting dividend. That's it for now, folks. And as always, I hope you enjoyed the video and that you learned something about investing today, and that you may join me for another video sometime in the future. As always, thank you for watching.